Hey traders, ever wondered how Forex trading really works? In this lesson, we'll watch Albert step into a live trading simulation. A friendly game with a professor that shows how prices move, profits rise, and emotions take over. Let's examine Forex trading as we go from theory to practice.
Welcome back, traders. Over the past few lessons, we've built a solid foundation. Now, we're ready to take the next step. In this lesson, we'll see how trading really works, how every move in the market reflects the constant push and pull between buyers and sellers. Let's get started. Today, Albert and I are stepping into the market, not just to talk about trading, but to experience it. I'll play the broker, and Albert will make his return as the trader. Together, we'll see how one trade can spark a roller coaster of reactions, from confidence to caution, and why understanding this process is key before you ever risk real money.
Quick reminder, trading isn't about guessing, it's about understanding how price moves and why. Now that we're moving from theory to practice, keep using your trading journal to take notes. Whenever possible, watch us on the larger screen so you can feel the classroom experience.
The current price of euros is $1.2000, meaning 1 euro costs $1.20. To open this position, we'll add $20 as security, what traders call margin. Albert predicts that the euro's price will rise against the dollar. If he's right, I pay him. If he's wrong, he pays me. Simple enough. Let's see what happens next. The first trade, shortly after Albert placed his trade predicting that the euro would rise, the price moved from 1.2000 to 1.2020. Now here's your question. If 1 euro started at 1.2000 and moved to 1.2020, what's the result of Albert's trade? A, he needs to pay more security money. B, he's winning because the price went up as predicted. C, he's losing because the price went up. You have 10 seconds. The correct answer is B. Albert is winning because the price went up, just as he predicted. Since he expected the euro to rise, and it did, his trade is now profitable, a gain of 20 pips. In Forex, even small price moves like this can lead to meaningful returns. In this case, if Albert were to close his trade now, he'd make about $2 in profit. Now, some of you might be wondering, how is that possible? The price only moved 20 pips. That's just 0.0020. Yet, Albert still earned $2 in profit. It sounds small, but in Forex, even the tiniest price movements can have a real impact when you're trading with margin or leverage. This is where the broker's trade size comes into play. They've applied a multiplier to Albert's small deposit, allowing him to control a much larger position in the market than his cash alone would normally permit. Here's how it works. Albert's $20 margin actually controlled about $1,200 worth of euros. In other words, the broker applied roughly 60-to-1 leverage, turning a modest deposit into a much larger position. So even though the price only moved 20 pips, that larger position amplified the result into a $2 gain. Albert's up $2 on his trade. Now he has a decision to make. Which of these choices is the smartest and which carries the most risk? Let's see if you can put them in the right order, from safest to riskiest. A, take the $2 profit now while you're winning. B, wait to see if the price keeps rising. C, ignore the trade and hope for the best. Or D, add more money to increase the trade size. Take 10 seconds to record your answer. The correct order from lowest to highest risk is A, take the $2 profit now while you're winning. B, wait to see if the price keeps rising. D, add more money to increase the trade size. And C, ignore the trade and hope for the best. Remember, in trading, protecting small gains is usually safer than chasing bigger ones. Discipline always beats impulse. Trade close. Albert decided to lock in his profit and end the position. As the broker, I returned his original $20 deposit plus the $2 gain. With just $20 at risk, he earned a 10% return in a matter of minutes. Not bad for a quick trade, but the real test comes with what he chooses to do next. The current price of euros is 1.2025. In other words, €1 now costs $1.20.25. Round 2. Albert still believes the price will rise, so he places another trade. This time, handing me the full $22 as his security deposit. Since Albert provided more money as security, I was able to increase his trade size. His position is now larger than before, which means every pip has a stronger effect on his results. But that also means even small price movements can quickly change his outcome, magnifying both potential profits and losses. Wait a minute. The euro just dropped. Breaking news pushes price from 1.2025 down to 1.2005. Albert is controlling 1,100 euros on this trade. How much is he losing? A, $20. B, 22 cents. C, $2.20. D, $22. Take a moment to think it through. The correct answer is C, $2.20. That's 20 pips times about 11 cents per pip for a position of roughly 1,100 euros. Altogether, that equals a $2.20 loss. Leverage magnifies small moves in both directions. Albert's confidence quickly fades as the market keeps dropping. His pulse picks up. Every tick lower feels heavier than the last. Nervous about losing more, he asked me to close the trade. I closed his position and returned $19.80. His $22 deposit minus the $2.20 loss. That loss hit Albert harder than he expected. The market moves fast, sometimes too fast. And in moments like this, every trader realizes something important. You need a better way to protect your money when things don't go your way. Now, Albert needs to think seriously about managing his risk. Which one of these can actually help him avoid major losses? Is it A, profit multiplier, B, stop loss orders, C, more leverage, or D, deposit bonus? Take a minute to help Albert choose wisely. The correct answer is B, stop loss orders. They're your first line of defense when the market turns against you. And that's how trading really works. Fast moves, real emotions, and lessons that stay with you long after the trade closes. Albert learned something every trader must face. markets move on their own terms. Next, we'll explore how to read those moves before they happen through the power of technical analysis. And that, traders, is how leverage and discipline can make or break your results. Every trade teaches a lesson if you're paying attention. Feel free to check out our next course on technical analysis. It'll show you how to predict market movements by studying charts, patterns, and indicators. See you there. Outstanding work, traders. You've just completed your Forex trading course, a major milestone on your path to profitable trading. You've seen how trades really work, how leverage can amplify results, and how discipline protects your account. But the exciting part starts now. We're stepping into technical analysis, where strategy meets skill. Let's keep going.
Thank you for watching. Great lesson today. If you want to go deeper, tap the video on the screen. We'll meet you there.